Welcome to this comprehensive revision of the SEBI Act, 1992, specially designed for CA final students. In this session, we'll understand why SEBI was created, how it is constituted, its powers, functions, enforcement mechanisms, and additional authorities under other laws. Instead of memorizing isolated provisions, we'll focus on the logic behind SEBI's role as the watchdog of India's securities market. By the end of this video, you'll have a clear conceptual understanding, along with exam-oriented retention points. Before SEBI came into existence, securities laws were scattered across multiple legislations such as the Companies Act, SCRA, and Capital Issues Control Act. As India's capital market expanded rapidly, there was no specialized regulator capable of effectively monitoring market abuses and insider trading. To address this gap, SEBI was first established in 1988 as a non-statutory body. It gained statutory status on the 30th of January 1992 through the SEBI Act, 1992, and later received additional powers in 1995. SEBI now operates as a body corporate with perpetual succession, a common seal, and jurisdiction across the entire country. Think of SEBI as the guardian of the securities market. The SEBI Act assigns three core responsibilities. First, protecting investors from fraud, manipulation, and unfair practices. Second, promoting the development of the securities market by encouraging efficiency and transparency. Third, regulating the market and all activities connected with securities trading. A simple way to remember this is protect, promote, and regulate. Every major power granted to SEBI ultimately serves one or more of these three objectives, making them the foundation of the entire Act. Before understanding SEBI's powers, it's important to know a few key definitions. The term board refers to SEBI established under Section 3. A collective investment scheme, or CIS, means a scheme satisfying the conditions specified in Section 11AA. Judicial and technical members refer to members of the Securities Appellate Tribunal appointed under specific provisions. Another important point is that if a term is not defined under the SEBI Act, its meaning is borrowed from either the Securities Contracts Regulation Act, 1956, or the Depositories Act, 1996. This ensures consistency across securities laws. Section 3 formally establishes SEBI as a body corporate. Being a body corporate means SEBI has an independent legal identity, separate from its members. It enjoys perpetual succession, meaning its existence continues despite changes in personnel. SEBI can acquire, hold, and dispose of movable and immovable property. It can also enter into contracts and sue or be sued in its own name. The head office is located in Mumbai, while regional and other offices may be established across India to facilitate effective regulation and supervision of securities markets. Management and control of SEBI rest with a 9-member board. This includes a chairman nominated by the central government, 2 members from central government ministries, 1 member representing the Reserve Bank of India, and 5 additional members nominated by the central government. Importantly, at least 3 of these 5 members must be whole-time members. The law also requires members to possess ability, integrity, and expertise in areas such as finance, law, economics, accountancy, administration, or securities markets. This ensures that regulatory decisions are taken by qualified professionals. The chairman and whole-time members can hold office for a maximum period of 5 years and are eligible for reappointment. However, no person can continue after attaining the age of 65 years. The central government may terminate their appointment before completion of tenure by giving 3 months written notice or salary in lieu of such notice. Similarly, members who wish to resign must provide 3 months written notice to the central government. These provisions create a balance between stability, accountability, and flexibility within the board structure. The Act specifies certain circumstances where removal becomes necessary. A member may be removed if declared insolvent, declared of unsound mind by a competent court, convicted of an offense involving moral turpitude, or found to have abused their position in a manner detrimental to public interest. However, an important safeguard exists. Before removal on the ground of abuse of position, the member must be given a reasonable opportunity of being heard. This reflects the principle of natural justice and protects against arbitrary removal. SEBI's decisions are generally taken through majority voting. In case of a tie, the chairman or the member presiding in his absence enjoys a casting vote. Equally important are the conflict of interest provisions under Section 7A. If a member is a director of a company and has an indirect pecuniary interest in a matter under consideration, that interest must be disclosed immediately. The disclosure is recorded, and the member cannot participate in deliberations or decisions regarding that matter. This ensures fairness, transparency, and credibility in regulatory decision-making. Section 11 contains the heart of SEBI's regulatory powers. SEBI regulates stock exchanges and securities markets, registers and supervises intermediaries, such as brokers, merchant bankers, portfolio managers, depositories, FIIs, and credit rating agencies. It also regulates mutual funds, venture capital funds, and collective investment schemes. SEBI actively combats insider trading, fraudulent activities, and unfair trade practices. In addition, it conducts inspections, audits, and investigations, promotes investor education, undertakes research, and coordinates with domestic and international regulators to strengthen market integrity and investor confidence. When investor interests or market integrity are at risk, SEBI can take immediate action. It may suspend trading in securities, restrain persons from accessing the securities market, suspend office bearers of stock exchanges, and impound proceeds of suspicious transactions. SEBI can also direct parties not to dispose of assets linked to an investigation. In serious cases, it may attach bank accounts or property for up to 90 days initially, subject to confirmation by the special court. These powers enable SEBI to prevent further harm while investigations are ongoing. While conducting proceedings, SEBI enjoys powers similar to those of a civil court under the Code of Civil Procedure, 1908. It can compel the production of books and documents, summon individuals, enforce attendance, examine persons on oath, inspect records of intermediaries and listed companies, and issue commissions for examination of witnesses or documents. These powers significantly strengthen SEBI's ability to investigate violations and gather evidence effectively. In practical terms, they transform SEBI from a mere regulator into a powerful enforcement authority. SEBI may impose penalties under various provisions after conducting the prescribed inquiry. Apart from penalties, an important enforcement tool is disgorgement. Disgorgement means forcing wrongdoers to surrender unlawful gains earned through securities law violations. Such amounts are credited to the Investor Protection and Education Fund, commonly known as IPEF. These funds are then utilized according to SEBI regulations for investor protection and educational initiatives. This ensures that illegal profits do not remain with violators and are instead redirected towards strengthening investor awareness. Apart from powers under the SEBI Act, SEBI also exercises delegated authority under the Securities Contracts Regulation Act 1956. It receives returns from recognized stock exchanges, inspects their records, approves or amends bylaws, conducts inquiries, and grants licenses in specified situations. Under the Companies Act 2013, SEBI administers provisions relating to listed companies and companies intending to list, particularly regarding issue and transfer of securities and non-payment of dividends. This integration allows SEBI to function as a comprehensive securities market regulator. Let's quickly recap. SEBI became a statutory regulator in 1992 and acts as the watchdog of India's securities market. Its three pillars are protecting investors, promoting market development, and regulating market activities. The board follows a structured composition and governance framework. SEBI enjoys extensive powers, ranging from registration and supervision to inspections, investigations, enforcement actions, civil court powers, penalties, and disgorgement. It also exercises delegated powers under SCRA and the Companies Act. If you remember the theme of investor protection and market integrity, most SEBI provisions become much easier to retain for the exam. Welcome to this advanced revision session on the SEBI Act, 1992. In the previous part, we covered SEBI's establishment, structure, and general powers. In this session, we'll focus on high-scoring exam areas, including prospectus regulation, collective investment schemes, investigations, search and seizure powers, registration requirements, anti-fraud provisions, financial administration, and penalty structures. Pay special attention to statutory thresholds, such as the 100 crore rupees CIS rule, 6-month document custody period, and the standard penalty framework, as these are frequently tested in CA final examinations. This chapter is highly scoring because many provisions follow a logical regulatory sequence. First, SEBI regulates securities issuance and market participants. Then it investigates violations, enforces compliance, imposes penalties, and protects investors. While studying, focus on 4 areas: powers under Sections 11A to 12A, investigation procedures under Section 11C, registration requirements under Section 12, and penalty provisions under Sections 15A to 15EA. Understanding the flow is far more effective than memorizing isolated sections, because exam case studies often combine multiple provisions into a single question. Section 11A empowers SEBI to regulate capital issues and protect investors before securities are offered to the public. SEBI can prescribe disclosure requirements relating to listing and transfer of securities, ensuring investors receive adequate information before investing. More importantly, SEBI may completely prohibit a company from issuing a prospectus, offer document, or advertisement seeking public money. Alternatively, if a complete ban is unnecessary, SEBI may impose conditions under which such documents can be issued. This provision allows SEBI to intervene at the very beginning of the fundraising process and prevent investor harm before it occurs. A collective investment scheme exists only when all four statutory conditions are satisfied simultaneously. First, investor contributions are pooled together. Second, investors contribute money with an expectation of profit, income, produce, or property. Third, the investment is managed on behalf of investors. Fourth, investors do not exercise day-to-day control over management. A simple way to remember this is pooling, profit motive, professional management, and no control. If even one of these elements is missing, the arrangement may not qualify as a collective investment scheme under Section 11AA. One of the most important exam provisions is the 100 crore rupees rule. If funds are pooled under a scheme that is neither registered with SEBI nor covered by statutory exemptions, and the corpus reaches 100 crore rupees or more, the arrangement is automatically deemed to be a collective investment scheme. This is known as the Deeming fiction provision. The purpose is simple. Large-scale pooling of public money cannot escape regulation merely by avoiding formal CIS registration. Once the threshold is crossed, SEBI automatically acquires regulatory jurisdiction to protect investors and supervise the scheme. Not every pooling arrangement is a collective investment scheme. The law specifically excludes activities already regulated under separate statutes. These include cooperative societies, NBFC deposits regulated by RBI, insurance contracts, provident fund schemes, company deposits, nidhi deposits, chit funds, mutual fund subscriptions, and other schemes notified by the central government. The logic is straightforward. Since these activities already have dedicated regulators and legal frameworks, duplicating SEBI regulation would be unnecessary. Therefore, before concluding that a scheme is a CIS, always check whether any statutory exclusion applies. After conducting an inquiry, SEBI may issue directions whenever it believes action is necessary for investor protection or orderly market development. These directions may be issued to intermediaries, persons associated with the securities market, or companies covered under Section 11A. An especially powerful feature of Section 11B is disgorgement. Disgorgement requires a violator to surrender gains wrongfully earned or losses unlawfully avoided through illegal activities. The objective is simple. Securities law violators should never be allowed to profit from wrongdoing. SEBI may launch an investigation when reasonable grounds exist to believe that market transactions are detrimental to investors or that an intermediary has violated securities laws. Such investigations begin through a written order appointing an investigating authority. This requirement ensures accountability and procedural fairness. The investigation framework allows SEBI to gather evidence, examine records, verify compliance, and determine whether violations have occurred. In practice, investigations form the foundation for many subsequent enforcement actions, including directions, penalties, and prosecution proceedings. During an investigation, managers, directors, officers, and employees must preserve and produce all relevant books, registers, records, and documents. The investigating authority may retain such documents for a maximum period of 6 months. After that period, the documents must be returned, although they may be called for again whenever necessary. Another important safeguard is the right to obtain certified copies of documents produced. This balances SEBI's investigative powers with the rights of regulated entities and ensures transparency throughout the process. When there is a risk that evidence may be destroyed, altered, hidden, or falsified, the investigating authority may approach a magistrate or designated court in Mumbai for authorization. Upon approval, search and seizure operations may be conducted according to the Code of Criminal Procedure. However, an important protection exists for listed companies and companies intending to list. Courts cannot authorize seizure of their documents unless there is involvement in insider trading or market manipulation. This exception is a favorite area for CA final case study questions, so remember it carefully. HE law imposes severe consequences for obstructing investigations. If a person fails without reasonable cause to produce documents, furnish information, appear before the investigating authority, answer questions, or sign examination notes, criminal penalties may apply. The punishment can extend to imprisonment for up to 1 year, a fine of up to 1 crore rupees, or both. Additionally, continuing default may attract a further fine of up to 5 lakh rupees for every day after the first day of default. This highlights the seriousness with which investigative cooperation is treated. Section 11D functions as SEBI's preventative weapon. After conducting an inquiry, if SEBI concludes that a person has violated or is likely to violate securities laws, it may issue a cease and desist order directing the person to stop the offending activity immediately. However, for listed companies or companies intending to list, such orders require reasonable grounds indicating insider trading or market manipulation. Think of a cease and desist order as a regulatory stop sign, designed to prevent further damage before violations escalate into larger market problems. Section 12 ensures that securities market activities are conducted only under SEBI supervision. Intermediaries, such as brokers, merchant bankers, portfolio managers, registrars, depositories, custodians, FIIs, and credit rating agencies, must obtain registration certificates before operating. Similar registration requirements apply to sponsors of venture capital funds, collective investment schemes, alternative investment funds, and business trusts. SEBI may suspend or cancel registrations when necessary, but only after providing a reasonable opportunity of being heard. This reinforces the principle of natural justice within the regulatory framework. Section 12A serves as the core anti-fraud provision of the SEBI Act. It prohibits manipulative devices, deceptive schemes, fraudulent practices, insider trading, misuse of unpublished price-sensitive information, and illegal acquisitions or takeovers that violate SEBI regulations. The section targets both direct and indirect misconduct and applies to securities that are listed or proposed to be listed. Whenever a case involves market abuse, insider information, or investor deception, Section 12A is often one of the first provisions that comes into play. SEBI's financial structure is governed by Sections 13 and 14. The central government may provide grants after parliamentary approval. All grants, fees, charges, and other sums received by SEBI are credited to the SEBI General Fund. This fund is used for payment of salaries and allowances, operational expenses incurred in performing regulatory functions, and expenditure on purposes authorized under the Act. This arrangement ensures that SEBI possesses adequate financial resources to perform its investor protection and market regulation responsibilities effectively. Financial accountability is ensured through rigorous audit requirements. SEBI must maintain proper books of account and prepare annual financial statements in the prescribed format. The Comptroller and Auditor General of India, or CAG, audits SEBI's accounts and enjoys extensive powers to inspect records, books, vouchers, and offices. The audited accounts and audit report are forwarded to the central government and subsequently placed before Parliament. This framework ensures transparency, accountability, and public oversight of SEBI's financial operations. A major exam shortcut is remembering the standard penalty applicable to Sections 15A through 15E. The penalty starts at 1 lakh rupees and may extend to 1 lakh rupees per day for continuing failure, subject to a maximum of 1 crore rupees. This common penalty structure applies to failures relating to furnishing information, client agreements, investor grievance redressal, mutual fund and CIS defaults, and certain AMC violations. Memorizing this single framework can help answer multiple questions quickly and accurately during the examination. Section 15EA is the important exception to the standard penalty rule. It applies to violations involving alternative investment funds, infrastructure investment trusts, and real estate investment trusts. Here, the penalty begins at 1 lakh rupees and may extend to 1 lakh rupees per day. However, the maximum penalty is not limited to 1 crore rupees. Instead, it may be 1 crore rupees or 3 times the gains made from the violation, whichever is higher. This prevents large entities from treating regulatory penalties as merely a cost of doing business. Let's consolidate the most important numbers. A non-registered pooling arrangement with a corpus of 100 crore rupees or more is deemed a CIS. Documents can remain in custody for a maximum of 6 months. Investigation non-compliance may lead to imprisonment up to 1 year, a fine up to 1 crore rupees, and an additional fine of up to 5 lakh rupees per day. The standard penalty under Sections 15A to 15E ranges from 1 lakh rupees to 1 crore rupees, while Section 15EA can extend to 3 times the gains made. These figures are extremely important for exams. For case study questions, always apply the law systematically. First, Check whether any statutory exemption applies, especially under the CIS provisions. Second, identify whether insider trading or market manipulation exists before applying special powers against listed companies. Third, distinguish carefully between standard penalties and the enhanced penalty under Section 15EA. Finally, never forget the principle of natural justice, particularly the requirement of a reasonable opportunity of being heard before suspension or cancellation of registration. Following this structured approach will significantly improve both accuracy and marks in CA final examinations.